All right, good morning, everybody. This is a Foundation Friday the 13th special with Sean Antonius. He's going to teach us about investment property analysis. And Sean, go ahead and take it away, bud.
All right. So I have a couple of really neat tools through a couple of services that I subscribe to. And I wanted to share one of them with you because it's kind of a hot topic right now. And we're also, Jenny and Kelly and I have put together a slide deck, and we're going to start doing some public facing in-person and webinar classes around this, just to try and help people create a little bit of, curb a little bit of their fear around maybe dipping their toe into buying a second home or an investment property of some kind. We know that, like, literally locally it's even more, but nationally people have an insane amount of equity in their homes and they don't know what to do with it. And recency bias, there's a lot of people who went through 2008 and they're kind of afraid to do anything. They're staring at their $200,000 or $500,000 in equity in their house, and they just like it. They like seeing it. They like it sitting there. And the reality is that's super frozen money. It's not doing anything for you. And it's one of the best tools that people can utilize to change the scope and the trajectory of their generational wealth by tapping into that and figuring out ways to expand their portfolio. Most people don't know this, but it's actually against the rules to have a financial advisor take HELOC money or equity money. If you get a HELOC and then give it to your financial advisor, they're not supposed to invest that money. One of the best uses of unlocking equity and in the form of a HELOC is to buy another home. So if you have clients who want to talk about this stuff and just kind of level up your own knowledge about how to speak about this kind of stuff intelligently, I want to go through a few things. Number one, there's some metrics and some definitions of things that I want to talk about that I don't have slides for. I'm just going to briefly touch on it because when I do this analysis, some of these things will pop up and you'll need to know how to kind of speak about them. Some metrics that we can use to evaluate an investment property or a property that's listed, maybe not listed, to see if it would be a good investment opportunity for you or one of your clients. The first one is net operating income. Forgive me if I'm not looking right at the camera because I'm looking at tons of stuff here. But net operating income is a simple equation. It's rent or your overall kind of top line income that the property is generating. And that includes everything. So if it's like coin operated washer and dryer, like there could be a couple $100, if this is like an apartment complex or something like that, or if it's just 2-unit or 4-unit multifamily, figure out all of the income generating possibilities of that property. Mainly it's going to be rent, but top line income, and then subtract out expenses, which are almost always taxes, insurance, and then any kind of maintenance withholdings that you're holding back, maybe $100, $200 a month, and you're kind of putting that in a slush fund. And I say like you're thinking about this as the investor about to purchase this property, right? So net operating income, or NOI for short, rent minus expenses, but that is before your mortgage payment. Okay. So actually, I am going to pull something else up real quick. I wasn't thinking about showing this, but let's start here. Cash flow planning for real estate investors. Load real quick. There's NOI right here. I'm on a call. Sorry, guys. Okay. Can you guys see that okay? Can I get a thumbs up from someone?
Yes, you're good.
Okay, cool. So net operating income, and this bubble right here, it explains what I just said. So this will actually give a little bit of numbers and color to what I just said. But gross rental income, so your top line rent income, minus expenses, taxes, insurance, any kind of maintenance, withholdings, that kind of stuff. What are you saving for to replace washer, dryer, a roof down the road, that kind of stuff. But it's before your mortgage payments. Okay, so that's really key. And then the other thing that we need to be able to figure that out really easily, because it is part of the equation to figure out capitalization rate, or cap rate for short, which is one of those buzzwords you've heard in the investment world. So scrolling down, once you know the NOI, you can figure out cap rate just by dividing the property value. Okay, so we're going to do this live with a couple of case studies in a minute, but I just want to go through a lot of these definitions real quick. Cash flow is another one, which is straight up just all your income minus all your expenses. Are you cash flowing or not? And then that translates into what's called DSCR, or debt service coverage ratio. Okay, which is the name of a loan product as well, which we can talk about that later. But figuring out your debt service coverage ratio, which is basically is your rental income covering the mortgage, and by how much? And then you put that into a percentage. Okay, it's just one divided by the other. And then the other thing is cash on cash return. You've heard of cash on cash. That's also a buzzword. So we're going to, actually, is that on here? I don't think it is, but we're going to talk about that when we do the actual tool here coming up. The other thing that you need to know and be able to eloquently explain to your clients is the 5 ways that you get paid by owning an investment property. A lot of people know maybe 2 of these, but they're not realizing and actualizing with real numbers and projections all 5 of these things. Okay, and then one of these things, talk about at the end. There's a tax loophole for those people who work in real estate, which real estate agents count towards. So number 1, appreciation, right? That's the value of the property goes up over time. Amortization is the balance of your loan going down over time. That's your money. Cash flow, which we just talked about, is the delta between rental income and all of your expenses, loan payment, everything. Depreciation, which is basically like reducing the value slowly over time, and you're getting credit for that on taxes. And then rent inflation, meaning what are the projections nationally, but also Snohomish and King County or wherever these properties are located. What's the projection for rent percentages to increase year over year? The last couple years have been crazy, but steadily they say that's about a 5 to 6% national rent increase, and that is just renewed tenants. The 6% can actually be more, like 8 or 10%, when you're swapping tenants out, and a lot of people do that too. So, and that increases monthly rent over time as well. And then leverage, understanding what leverage is and why investing in real estate and using the overall value of the underlying asset as what you're factoring your returns on. Okay, so for instance, and you guys know this because you're in real estate, but I like to say it, and I record a lot of reels about this stuff. But if you take 20 grand and you put it in stocks, the return is based on that 20 grand. But you say, take that same money that you're risking the exact same amount of money, and you put it in real estate, but you're controlling a $400,000 asset. The return is based on your $400,000. So you invested the same amount of money in both. But if you want to profit $20,000, you need 100% return on the stocks. You only need 5% return on the real estate. So you can make 20 grand in real estate probably in 1 year. National average of appreciation is 4% a year. To get that 100% in stocks, you probably need 10 years, 8, 10, 12 years to get that 20 grand. So obviously, that's what leverage does for you. A lot of people are very anti-debt, but there's a section of debt called good debt. And that's when the underlying asset is an appreciating asset. That's good debt. And being able to explain that to your clients is extremely beneficial. And hopefully you can spark some new conversations with different clientele by mastering some of these things. So we got some of the terms down. We're going to actually start doing some of these things, but I want to go through one by one a couple slides about the 5 ways you get paid. at 4% annual growth, which around here it's a little bit higher. King and Snohomish County, I think national for a historical average is more like 5 or 6%. And then obviously the last 4 years has been 10, 15, 20%, which has been insane, but that's not sustainable. But let's say you hold something for 20 years, you bought it for 600, 20 years later at 4% annual growth, it's a $1.3 million property. This is annual appreciation nationally dating back to 1942. Okay, so this is the giant in the room, and that you can show any client this and they'll be like, oh, because you get this question all the time. When's the market going to crash? When are prices going to come down? You know, a crash, quote unquote, is quantified as like a 25% drop in 1 year, and that's just probably never going to happen. The closest that got was like in here, where there was a run of every year property values went down, but that was a complete outlier. Other than that, there's been 1, 2, 3, 4, 5, 6 years in the last 80 where there wasn't a green number. Okay. This is, I mean, you can screenshot this or I can send this out, but this is very telling of historical appreciation numbers. And again, this is national averages. This is not locally. We know locally some of these numbers are probably even higher. Amortization, that just means over time you're going to pay your loan down, right? So it's kind of like a forced savings account. So a 20-year loan balance with 20% down at 5.5 interest rate, which we know is a little bit higher. And we're going to actually do some of these case studies with a much higher interest rate, because those are the questions you're going to get. And it doesn't change the fact that owning investment properties is an extremely wealth building activity for your clients. So, but again, 20 years down the road, you've paid this balance down, say 480 at 5.5% interest. 20 years later, the balance is this. That's your money. That's the investor's money. They get that money back. Obviously not the interest, but the balance on the loan. Cash flow, 20-year rental income, 4% annual increase in rent. So if you start at $2,800 a month, if this number holds, 4% annual increase nationally, then 20 years from now, you'll be getting $6,100 for that property a month. That's also your money. Okay. So after 20 years, your value went up, the rental income went up, the loan balance went way down. With a fixed mortgage payment of $2,725, which is monthly cash flow of $3,400, you could refinance and do a cash out of 75% LTV in 20 years and take $730,000 out of this property. Your payment would go way high, $5,500, but it's still cash flowing if these rental projections hold up. Does that make sense?
Yeah, Sean and Katie just asked if you would be able to send these charts.
100%.
Cool.
Yeah, happy to. All right, so this is the next thing. That's pretty much like the presentation part. The rest of this, I want to just kind of play with some case studies so I can show you how cool this tool is. So I have a couple properties that I just wrote down some addresses. And then, after we look at these three, if you want to throw me some addresses, I can do this real quick, or you can send them offline and I can do these reports take literally 5 minutes and I can send them to you. So feel free to ping me and shoot me some addresses and some numbers and I can build any of these reports you want. The first one is a really cheap little property in Everett, which is already pending, which I figured it would be. I looked it up like 3 days ago in preparation for this because it was like so affordable on Grand Avenue, but it's obviously tiny. But man, what a good starting point for somebody who wants to kind of dip their toe into owning an investment property. So there's some metrics on here. And then the other thing I want to do is maybe you have some other tools for this to figure out like market rent or what this property might actually rent for. But I don't. I just use this tool and get a good guess. median rent in the area, 1525 for this particular property. I'm gonna guess, since it's fully renovated and on Grand Avenue, I'm gonna guess that it's on the much higher range. I'm betting this place could go for at least like $2,000 a month, maybe even more. 1 bed, 1 bath, 2,200. It's really close to a couple hospitals. Maybe you can do traveling nurse type stuff where you furnish it and then do 13-week, not long, not short term rentals, medium term rentals. That's kind of all the rage right now. And you can go much higher. You can go 2,500 bucks a month, $3,000 a month for stuff like that, for the medium range stuff. But if I were to guess, I don't know, you guys are better at this than I am. I'm going to put in like $2,000 a month and we'll see what happens. So I'm going to go here. This is MBS Highway. This is a product I subscribe to, and there are a lot of really cool analyses that I can do for you guys on here. Unfortunately, I don't have like a calculator and the Excel spreadsheet I can just send you and you can do this yourself because it's an online login. But there's an investment property analysis, buy versus rent. If you have any renters who are like, I'm thinking about maybe waiting 2 years to buy when rates come down, a buy versus rent analysis is extremely telling, showing them that's a terrible idea, waiting, but showing them with real actual numbers. Appreciation analysis. There's a cost of waiting analysis similar to that buy versus rent. Debt consolidation. If you got some people who want to use HELOCs to consolidate their consumer debt, car loans, student loans, credit cards, those are at an all-time high, and national savings accounts are at an all-time low. So people are starting to think about figuring out a way to get out of debt. But anyway, I want to use this one today. I can show you guys any of these you want. They're extremely useful, but I'm going to put this Everett property in here. It's going to pull up county numbers. I'm going to buy this thing for asking price. And then we're going to tweak a bunch of these numbers. All right. So I'm going to start with this. I think it's going to rent for a little more. National annual rent increase, we'll put 6%. Vacancy, I'll probably put a month in there. Maybe up to a month every year, it's going to be vacant. We got to account for that. Here's your price. I don't think those taxes are right. 234 times 12. 2808. Let's change that. For annual taxes, homeowners insurance, I don't know. That seems a little high. No association. Property tax increase, let's account for that. Let's put a 1 or a 2% in there. Home maintenance, this is money you're going to hold out every month to kind of build a slush fund to keep the property in good order and continually have money available for repairs and stuff like that. Property management fee. Here's where, if you're going to do this yourself, Mr. or Mrs. Investor, you don't need to put anything in here. But if you're going to outsource property management, you might put a 10% in here, and then it adds that fee in here that they're going to just withhold 10% of the rental income and take care of the property management for you. You can put 5%, you can put 20%, put whatever you want. And this thing just live updates and extremely helpful. Any upfront costs you're going to put into the property, right? If this is not already flipped and you're going to put 20 grand into it to clean it up and do the BRRR method of investing, and one of those R's is renovation, got to account for that. Are we putting 20 grand in here of upfront cost? Okay. Maybe not. I'll just leave this out for now. All that does is really prolong some stuff. Loan amount, 300. I'm going to put this a little lower. I'm buying it for 375 and I'm putting 100 down, right? So I'm leveraging 275 from the bank and 100 of my own money. I'm going to put this thing at 8% just because that's kind of where we're at. Might even be 9% for investment or some sort of like non-QM product. If you're going to use DSCR, you're probably not getting an 8%. No mortgage insurance, closing costs, whatever. It's probably about right. 10 grand, give or take. And then how long, Mr. or Mrs. Investor, do you want to hold this thing for? 10 years, 5 years, 15 years? You can change that in here. So this can be extremely like customized to your particular client's situation. And then it pulls historical appreciation and forecasted appreciation for our particular county where this property is. If you want, you can put your own custom one in here, or you can just use what it pulls as historical and projected, about 5.5% for value appreciation. Okay. So if we go back and we look at these, this is where some of our terms that we discussed in the beginning, when you're able to explain some of these things and what this report actually is showing to your clients. Here's your income. So your net operating income is your income minus your expenses before this number. So it's really this number minus these numbers, and that's your net operating income, or your NOI. Okay. Total expenses is here. Total cash flow is here. And these numbers don't look that good, but when you look at the overall cash on cash, which is all the way down right here. That's the cumulative, also not great. We might need more rent on this. But it stacks all these things with 10 years of appreciation gain, $30,000 of amortization gain. So you've paid your loan, or your renter has paid this loan down 30 grand over 10 years. Both of those things are your money. Stack those things together. There's your rental income. There's your appreciation minus all your expenses, which includes your mortgage payment. And it shows what it includes. There's your profit in 10 years. And then you take this and divide that with, that's how you get your cash on cash, is the total return divided into the initial investment. So the total return was 200%, and then annualized compounded is almost 12%, which if you look at, stocks or S&P or whatever, anything else you can invest in with a financial advisor, you'd be lucky to get over 10% on anything. Right. So
not right now. You'd be lucky to get like 5%.
I'm talking about like 50-year averages, and it's probably still not even 10%. It's probably between 5 and 10 is my guess. But right now, yeah, you're right. It's probably even worse. So rate, this is one of the most telling things that because so many people are focused on rate, and you guys get this question all the time. This doesn't really change anything at all. I could put a 10% in here, still a ton of profit. I mean, we can even do the math. 176 at 10%, we drop a full percent. What did that change? Oh, that's the year. Sorry, I'm not changing the rate. So 205 with a 9%. 1% difference, 176. So you're talking about 30 grand spread over 10 years. So $3,000 a year. The biggest thing is having it at all, right? The appreciation, the market appreciation, the amortization buy down, and the fact that, this particular one isn't the best because there's negative cash flow. I have a couple of others we can look at. Let's do at least one or two more. One of these, because I have a lot of clients, not a lot. I have two particular investor clients right now who are buying up multifamilies in Cleveland, Ohio, of all places, because prices are insanely low, but rent is very high. And it's one of those areas that's like that metric is a little bit out of whack right now, but the projections of that metropolitan area are that appreciation is going to happen over the next 10 years. And a lot of people are going to end up moving there. So values will continue to rise. So let's try this one, 6215. Cleveland, Ohio. This, I think I found last night, is a 3 unit. So you're getting rent from 3 units, and it costs $150,000. Okay, so you're buying a triplex in Cleveland, and that's one of the other things I talk to investors about all the time. There's this misnomer or quirk where people think that they need to buy an investment property near where they live. And so a lot of people think, well, if I'm going to buy an investment property around here, stuff's so expensive, it doesn't pencil. You don't need to think that way. You can literally buy these things anywhere. And then you just outsource the property management. And when it cash flows like something like this, obviously there's going to be, look at these pictures. You might sink 20 or 30 grand into renovating this thing, but at this price, who cares? So if we run this analysis, we can start over.
If how many of us are there? About 11. We all chipped in like 15 grand. We could just buy this thing.
There you go. There you go. Cleveland, Ohio. We're buying this thing for $149,900. See, it already picked it up because it knew it was listed. This thing, let's see. Yeah.
What is this Zillow tool you're using?
I just Googled Zillow rent estimator, and I just pop in the address and a fake email.
Trying to give you some not silence during your looking up here.
You're good. So Zillow thinks this thing, average rent in this area for this size of something, 12 to 1,800. I'm going to times that by 3 because this 9 bedrooms is split into three units. So could we get $1,200 a month times 3 for this place? 36, 37, up to $4,000 a month total in rental income. So let's be conservative and say $3,600 a month. There's your annual rent increase. Account for a little bit of vacancy. I'm going to go 4% on this because there's 3 units, so you're diversifying your vacancy rates. There's your price. I don't know if this tax is real, but I could look it up. What does taxes look like? That can't be right. That's got to be a senior exemption. $44 a month for that whole property. No way. Let's see. Anything else we want to change? We're going to outsource property management on this guy because it's in Ohio. So I'm going to put 10% in there. 6% cost to sell. Loan. What are we going to put down? 20%? 20, let's go 25. So we're only leveraging 112 grand from the bank at 8. I'm going to put this up a little at 9%. Cheap closing costs. 10 years. I'm going to hold this thing. Average historical appreciation in Cuyahoga County, much lower than here, but still something. Here's the thing though. You risked way less money to buy a cheaper property like this. You're leveraging a lot less money. So your principal and interest payment is much lower, like not even $1,000 a month, even at 9%. And your rental income's crazy high. So these numbers are just like kind of bonkers. 600% cash on cash return. You can see how the cash flow, you're already cash flowing from day one, even with the money that you've invested up front. Appreciation gain, amortization gain, rental income is a big one on this one. And then appreciation in it isn't as big because it's much slower. And the percentages are lower because you started with a lower number. But after your expenses, which are also low, you're profiting 300 grand in 10 years. So all you've risked was what? Not even $50,000, $40,000. And you just put $40,000 in something and you made 300 10 years from now, which is an 800% return or 25% a year. So you can see that these numbers are, and I can export these into PDFs for you. We can co-brand them, or I can take my face off if you want. And I can give PDFs of specific, you can put these at your listings, whatever you need.
Hey, real quick, Sean, Russ
Yeah.
asked a question. He said it may be an offline question, but he's just wondering if you're familiar with self-directed IRAs and non-recourse loans and how they would
Yes.
play into these scenarios.
Yeah, 100%. So a lot of people, you know, there's two very traditional ways that people use to get into properties like this. Obviously, qualifying with your own income is the best way. So, you know, if you're self-employed, a lot of people have trouble showing income on paper when you're self-employed, because self-employed people obviously go to the ends of the earth to reduce their tax liability, so they expense the crap out of everything. That's where DSCR comes in. DSCR loans don't require any income documentation. We just need a credit score, and then we show that the rent's going to cover the mortgage payment, and that's pretty much it. As long as you get a 1% on debt service coverage ratio or higher, you can have the house and you don't have to show any tax returns, W-2s, pay stubs, nothing. Okay. So those are the two main ways. There are also IRA distribution type ways, especially for, I don't want to be ageist, but older folks who just have like more money than they know what to do with, and it's in these investment accounts. There are ways to deplete IRAs to show income. Fannie has a really, it's kind of, I don't want to call it a loophole, but it's a pretty unknown guide that, you know, you can just set up an IRA distribution for stuff like this, for property acquisition. You don't have to maintain it. I would say open it up, get it started, you know, distribute 10 grand a month or something like that, and then let it go for like 90 days. The loan closes, and then after the loan really gets sold to Fannie Freddie, say 60 to 90 days after the loan closes, nobody actually cares if they continue to leave that distribution open. So shut it off, right? So like, don't deplete your IRA. But as long as there's enough money in an IRA to show 3 years continuance, so whatever that set amount of monthly distribution is times 3 years, if your IRA will cover that, then you can qualify to use that as an IRA depletion. And that's a straight up conventional loan. That's not even non-QM or anything. So I appreciate you monitoring the chat, because the way I'm doing this, I don't really see. Oh, here we go.
Yeah, no
Russ,
worries.
if you want to talk about that more, we can talk. I think that answered your question. But yeah.
And then just so everybody knows, I happen to know this, like, well, why would Sean be showing properties in Ohio, and you are licensed to do loans? It's every state, or like 48 states or something?
There's 8 states I don't have.
Okay.
So it's 42 states. Yeah.
Yeah. So
I'm part of a national, there's kind of 2 ways licensing works.
Yeah.
Most IMBs who do what I do, they have to go do CE and licensing in each individual state you want to be licensed in. I'm actually, our parent bank is a nationally chartered commercial bank, like a Bank of America or a Chase. And if you work for one of those banks, you get a national license. And so that's what mine is. So yeah, a lot of lenders will say like, oh yeah, I can do loans in Ohio, but then they'll refer you to somebody within Fairway or something that's like in their network, and they'll do the loan in their name and then send your lender a referral fee. So they're not actually doing the loan. I actually do the loans. Did I miss any other questions? Sorry if I missed this, but charge curious.
No, you're good.
Oh yeah, Katie, sure. Yeah, and so I put my seanslinks.com. That's like links to every single thing about me. You can email me, ask any particular questions you want. If you want to go out to coffee, I'm happy to do that. Just chat through any particular scenarios. But yeah, here to help. And then again, if you want to take some time to maybe, we can do one-on-ones in person or on Zoom, and I can show you some of these other stuff if you're interested in stuff like this. You have a listing and you want to see a real estate report card for your listing coming up. Let's use that same.
Is this tool free or
I
we'll
pay
have to
for it,
buy
but I'm not going to charge you. You can have as many of these as you want.
Mhm.
So yeah, here's a real estate report card for that particular property. Forecasted appreciation, supply and demand, and demographics for the area. Median household income, historical appreciation. I mean, just kind of cool metrics about the area or that particular section of town where you know a potential buyer might be interested. You could print some of these off and co-brand them, put them at your listings, have them at open houses. Buy versus rent, housing price index map. This is really cool. Housing price index.
That last one, that report card deal, man, I would think just about every house I have, I'd want to have one of those there. What is it we learned yesterday at the somebody, I think 20%, or is it 17 or 20% of all purchases right now are investors?
Yeah. I read something the other
number.
day. It's BlackRock, the private, they've raised like 20 or 30 billion specifically for the purpose of buying residential real estate. So I mean, I read an article, I can't remember, it was CNBC or something, that said 10 years, like fast forward 10 years, 40% of the nation's residential real estate will be owned by institutions. So you're competing with VC money, like your individual local buyer, you know. So the more you know about this kind of stuff, you know, appreciation projections and being able to kind of eloquently explain real estate as an investment, like follow the money. Like these people who are billionaires are raising VC capital to buy residential real estate because they see it as the safest play in the next 20 or 30 years. Commercial real estate's on a huge decline.
You know, having that initial calculator, even for first time home buyers, right? Because even if you're not renting, I think just seeing the fact that over a 10-year period, even on that first one where it didn't cash flow, which is like kind of where everybody's like, oh, I want it to have income. And it's pretty hard to find income producing rentals
around here.
Area, right.
Yeah.
I mean, you have to get outside of, you know, some of the bigger counties now, or, you know, really find something that you can fix up or whatever. But even just buying one that was already ready to go. And you're right, Sean, I've been hearing about this as well. These sort of, they're not VRBOs, but they're the kind of midterm and short-term rentals to either digital nomads or nurses, or sort of the two big categories. So if you have a place that's really tech friendly, you can kind of, you know, get some of those what they're calling digital nomads. But the traveling nurses, and you're right, being right next to a couple hospitals, and they'll come in, and if you go to IKEA and you deck the thing out, right, make it look like it's staged, and provide that furniture, and now you can get, you know, significantly double the rent for a short-term rental, and then you can get it to cash flow as well. But the fact that it still produced, you know, what was it, 250 grand, even as a one bedroom, even paying, you know, our premium, I think is helpful. So
yeah, traveling nurses, most of those companies who, I mean, hospitals are all so understaffed right now. So traveling nurses is all the rage, and they're paying crazy amounts of money to outsource nursing like that. They're 13-week contracts, and they have to have somewhere to live. And so, you know, I actually know some people. One of my coaches and Neo founders, he owns a couple hundred doors in Park City, Utah. He switched one of his entire units. It was like a 20 door apartment complex that he owns. He went and furnished every single one of them, and he switched that whole complex to medium term rentals. And then you find out who the traveling nurse companies are. There's probably 2, 3, 4 that are most prominent in the area. You find out who those are, and then you just talk to their placement people and like be the housing option, or you know, have some of your investment properties be a housing option for that company, and you'll just have people placed all year long.
Yeah, and executive short-term for reload companies as well, right? So reload's always calling, do you have a short-term rental source available, and that's because there really aren't out there. So if you provide that, they're going to fill those up right
and
now.
when it's corporate paid versus like the renter is paying it, like a traveling nurse, for instance, and their corporation is paying for their housing, they'll pay any amount of money. They don't care. That Grand Avenue property, they'll pay $4,000 a month for if it's furnished, and they can just drop somebody in there without thinking about it. So there's a lot of opportunities for people. But this isn't just, I mean, I wanted to figure out a way to kind of, I don't want to say dumb this down, but make this extremely simple to understand, especially for newbies, right? People who have all that HELOC money or equity money that's available in their houses and they don't know what to do with it. Dip your toe into owning a second home and renting it out. It's not as scary if you have an advisor like you in their life who understands all of this stuff and can walk them through short and long-term projections of how this stuff works and really teach them. This isn't just for the savvy investor. This is available to everybody. And it's all about education and getting the word out.
Kylie is curious as a realtor how she can help her clients interested in investing out of state, right?
I mean, so as on the realtor side, correct me if I'm wrong, but you guys have referral networks, right? So, you know, you vet a trusted, reputable realtor in that area and then work out a referral fee. Just make sure they're taken care of. But again, I can do loans anywhere, virtually anywhere. But yeah, you're a bit limited with proximity and licensing on the real estate side.
Yeah, and you know, so you can hand out the lead, you can hand it to the reload department, or you can also go into, like, if you wanted to try to get into Ohio, what I would do is I'd probably go to some Facebook real estate groups in Ohio. I would try to search out, you know, what looks to be a very good agent, not maybe one of the best, but you know, very good, and build the relationship, right?
Yeah.
If I start sending you clients over, you know, and set up that referral fee, and just know what the relationship is. You can talk to them about how you'd like your clients to be handled, what your intentions are, what you're looking for, et cetera, et cetera.
And now you're the option for their clients coming this way as well, which is probably more opportunity of people coming to one of the tech capitals of the world from other places. I know a realtor who, through the real estate mastermind group, I mean, there's several thousand realtors in there on Facebook, and it's a big group. She built her whole business on just building relationships in other places and being the referral option for the Seattle area for a large group of real estate agents. I mean, there's a lot of business opportunities to get from those groups. If you give, definitely expect reciprocity.
Awesome. Is there any other questions for Sean? Yeah.